Okay, everyone, welcome. Welcome, welcome. It is our September webinar. Can't believe it's September already. We're trying to run these every month or so with the team at Altos to get our clients and colleagues the best information we can about what's happening in the real estate market. And today we're going to hit the national data, what's going on right now, some of the key interesting trends to keep your eye on. We will, and then we'll dive into a little deeper to some of the state and local things and some of the back end of the Altos system. A little housekeeping before we begin. We do have some of the Altos team on the chat today. So if you have questions along the way, drop them into the chat. If you are interested in understanding how we do the data, or want to see the data for your market, you want to book some time with the team at Altos, drop that in the chat. We will be monitoring the chat and we'll be trying to answer questions and guide along the way. So we will be going for about 40 minutes today, I think, and diving in as deep as we can. If we have time and there are specific questions like specific markets or interesting things like that that we want to look at, then we'll spend some time there as well. So make sure you use the chat as best you can. We have a lot of folks on the call. So what we want to do today is 2020 is obviously a remarkable year. It's a different world than we've had before, and it's different for real estate consumers. And what I've been observing is that a lot of folks, if they haven't been in the data like we have each week, they are really surprised at what's going on. They're unaware that home prices are climbing, or that the inventory is so tight and they're not sure why. So what we want to do is show folks what's actually happening right now, help them understand what's likely to happen in the next few months. And really, I'm going to start looking through the beginning of January. We have some visibility now on where 2021 is going to start, with some caveats of like, there's a lot of uncertainties in our world today. And then we're going to also, spend some time with the key leading indicators that you should watch, that you can have your clients watch, especially people who are first-time buyers or investors looking for opportunities. So a lot of folks who've been waiting with cash and who are trying to decide if now is the right time. And then we'll dive into some data, some live data. We'll use the Altos product and we'll look at some of the state and some of the local things, see what we can do and how we can interpret what's going on in the country right now. Okay, so without further ado, let's dive into some data. The total inventory in the US, total available inventory of homes for sale, this is single family homes for sale, it fell another 2,000 homes this week, down to 591,000 homes. This is, what's interesting is new listings are actually climbing. There's a 77,000 is about as high as it's been this year. So that's new properties coming to market. That's actually, kind of a relief. It gives realtors and buyers more options. But demand is so much higher that total inventory keeps falling. And you can see here the red line, this remarkable red line of this year. We're at under 600,000 homes, and even just a few years ago, 1,000,001. Before that, earlier in the decade, 1,000,002, 1,000,003 homes would be for sale right now. This is like normally the peak of the inventory session. This chart is super powerful for communicating to folks what's happening. And it's pretty much true across price points and across the country. There are a couple of places that I'll show you where inventory is climbing, and what that means at the local level. We'll do that in the second half of the webinar. So total single family inventory down to 51,000 homes this week. Um, we expect, what's interesting is you can expect we go in, there's usually a couple of weeks in September when inventory climbs a little bit. That's because transactions slow at the start of school, a few more homes get listed for the end of the summer. And then by the end of September, October, November, homes are getting absorbed, very few getting listed for sale. Some of them get pulled off the market for the holidays, and inventory falls. Inventory, so you can see the different colors here is a new year. Each new year is a different color. And we had just a couple of weeks in March of climbing inventory in 2020. And then the rest of the year, when normally we'd have all this inventory increasing, inventory dropped rapidly every week from April all the way through now. It'll be flat for, a couple of weeks here in September, and then you can expect inventory to pull back so that we may start the year 2021. The second week of January is when we get our inventory turn. It starts the new listings for the springtime, but we may be at 378,000 homes for sale for the whole country. It's insanely low. That would be, half of what a normal January would start at, and really like a third of what a healthy market would be. So we can forecast that now because, things are going to be selling as much at the end of October and November and December, of course, the holidays, before we get our reset. So it's crazy. There are signals of in this part of the looking at the data, total inventory data. It's always wise to check in on the 3.8 million homes that are in the mortgage forbearance program. So these are 3.8 million homeowners. It's like 7.5% of all mortgages that have been in this program to not pay their mortgage during the pandemic. Some of them are paying, some of them are not paying. At the end of September is the end of the first 6-month window, the first 6-month negotiated forbearance period. So in October, it is possible that we could see some of those properties come to market. At the end of that negotiated period of forbearance, the homeowner, the mortgage borrower, either needs to up for another 6 months of forbearance, or start paying the mortgage, or sell the house or something. There is a subset of folks in that period in their forbearance. Most of them are going to re-up in the program. The number of folks that are in forbearance is ticking down each week. So that's generally because they're moving and paying off their mortgage, or they're restarting their payment, etc. They're like in a relatively healthy space. But there are some folks, the majority of folks will re-extend for 6 months, which will end March, and therefore April will be the next moment that's going to have some potential for inventory. There is one window in between that could offer potential for new inventory coming on. The foreclosure moratorium is currently extended through December 31st. So if you're not paying your mortgage and you're not in a forbearance program, then the clock would start ticking January 1 on a foreclosure process. There are folks who, for example, are in forbearance, but aren't responding to their mortgage companies, and therefore are not extending their forbearance. So if they don't extend, they're probably, two things will happen. One, their credit will start getting hit, but they won't go into foreclosure process until January 1. We don't know how many folks are going to be in that space, but there would be a time, unless that window gets extended again, that then we would start for 2021 having a little bit of the inventory of folks who are in a foreclosure process or need to sell to avoid foreclosure. And frankly, the way it looks right now, because prices are high, equity is at record levels, homes are moving fast, it seems unlikely that we're going to get a wave of foreclosures, but more likely that we might have folks that say, well, I'm going to take my cash now. And so for realtors, that communication of the opportunity to walk away with your cash pretty quickly because demand is high is a listing opportunity to take advantage of. And so your dates are October for people who aren't renewing their forbearance. There's December 31st if the foreclosure moratorium ends as currently scheduled. And then there'll be another window in March and April for folks who are in that space. As of right now, though, we've seen almost none of those come to market, and certainly none coming as distressed. So that's what the inventory case looks like right now. Here's an interesting thing. That's supply. On the demand side, the demand is held up primarily or importantly because interest rates have been record low. And you can see when we look at interest rates and we use the Altos Research Market Action Index. If you're not familiar with the Market Action Index, this is a number that we built at Altos Research that looks at demand versus supply. So when demand is increasing, this number climbs, and when demand is decreasing, this number falls. It's a at a glance measure for how's the market. And what you can see over time, the green line here is the market action index. So this is a couple years, 2.5 years of the market action index. 2018, as rates were climbing, demand was falling. At the start of 2019, we were at 5% mortgage interest rates for the 30-year fixed. The 10-year average, the average for the decade of the 2010s is 4%. So all of a sudden through 2018, we're climbing to 5%, and 5% feels expensive because it hasn't been there for a decade. Demand fell down and inventory climbed at that point. Transaction volume decreased and the market action index falls. Then in 2019, interest rates fall all year and all this year too. So we are now a year and 3/4. We're at 20 months of falling interest rates. And likewise, you can see in 2019, the normal seasonal fall second half of the year was very muted on demand because money was getting cheap. We had our demand then kicked off 2020 already in a hot market. We've talked about this before. We had a few weeks of pandemic lockdown and then boom. And interest rates are just cratering and demand is just skyrocketing. And frankly, this is an affordability metric. It is significantly more affordable to buy your home at 3% than it is at 4%. And just 18 months ago, 20 months ago, it was 5%. So what this tells us is the risk for the next year is if interest rates probably climb above 4, we will see I would expect us to see a pronounced slowdown in demand in the same way we did in 2018, which is the last time we saw that. And then again to the issue, the conversation that happens around Is there a wave of foreclosures, distressed properties, the vulture investor types sitting on the sidelines with cash? Can they expect to have these crazy bargains happen? The answer is, in when the bubble burst in 2007, interest rates were 6.5%, significantly higher. Equity was at record low levels, and the result is that you have higher holding costs, you have less equity, and people, therefore, it was made much more sense to just walk away. And so then you ended up with all the distressed inventory. We don't have any of those conditions now. We have ultra low rates, and we have demand high, and we have record levels of inventory. So even if you're in the forbearance process right now, you might choose to sell, but you are probably not walking away from the property. That's where the inventory and demand set looks for the next few months. We always like to look on in the weekly data and on these webinars, the percentage of homes taking price reductions. So remember that when properties get listed for sale, about a third, 35%, are overpriced. And sometimes that overpriced is intentional, strategic, and sometimes that overprice is accidental. Sometimes it's a crazy seller, whatever the reason. About 35% take a cut before they sell. When demand is high, that 35% thinks they're overpriced. And some of those strategic overpriced, they get the offer. They never had to cut their price. So fewer and fewer homes have to cut their price. So we look at the percentage of homes taking a price reduction as a leading indicator of where transaction prices are going to happen in the next 2, 3, 4 months. And what you can see here is the strong seasonality. Normally the green dot, where we are late summer, is sort of the high end. We're starting to reduce prices to move properties before the end of the year, right? We don't want to be stuck with a home in November that's been on the market since July, so they get cut. And then over the holidays, it's new inventory, it's relisting, it's the junk gets pulled off the market. And so we have each year this January reset in price reductions. You get new inventory here, they don't have to take price reductions till later in the year. And of course, here's what happened in 2020. We had our normal reset, was already very low, 25%, showing strong demand. And then in April, it started ticking down. We've got our July started our little peak, and now we're kind of going horizontal. So you can see our whole seasonal reset is way lower than a normal year. Like we're on 25, 26% instead of 36, 37% of homes taking price reductions. That's because there's demand in the market. That's homes getting listed and sold quickly. That's multiple offers. And that says that the homes that are listed now and the prices that we've got now hold up for transactions that happen later in September, in October, and November. If demand backs off and all of a sudden this hot market starts to feel not hot, the listers are like, wow, we don't have any traffic, you'll see this number climbing. But what's fascinating is we're normally at the holiday season, so it's going to, the junk comes off the market. So we may actually see this guy fall and have a seasonal reset around 20% because our inventory is so tight, under 400,000 homes, and because the rates are cheap, so demand is still there. It's a remarkable signal, and it's the one to keep an eye on in your local market, and have your sellers keep an eye on it, have your buyers know what's going on. So for your sellers, the conversation is, look, we have demand, we have tight supply, and while we have your house listed, we'll be able to look at, for example, some of these metrics like price reductions. If this is ticking up, we're going to know it, and we'll see it, and we may choose to get in front of the demand change and maybe do a price reduction sooner. For your buyers, these are your buyers who are like, hey, I'm on the sidelines. I'm thinking about buying in the next year, but I'm waiting for the bargains. I'm waiting for the bargains. And the question is, how long are you going to wait for those? The demand is there and price reductions are not happening. So prices are at least holding up for the next quarter. And you can really see that with this leading indicator using the price reductions. So that's all the supply and demand. Let's talk about pricing. Prices are obviously at record highs. They're up 8.7% year over year, a remarkable up year in home prices nationally. This is normally the time of season when we've passed our peak, and we typically go horizontal here in the fall before a November, December price reset for January. So these are your strong seasonal patterns. We're going a little bit horizontal. We're ticking down a little bit week over week, but basically holding at our record high levels. And again, you can see it in the supply, you can see it in the demand, you can see it in the market action index, and you can see it in the price reductions, that these prices are holding up and they don't need to adjust down to move the properties for the fall. So those bode very well for pricing. This is, the ask price. These are list prices. And what happens is house gets listed now in September. It gets an offer in October. It closes in November. And the traditional data points, the headlines that you'll see, the transaction recording, the tax records, start in November and December. But because we can look at the subtle changes in the active market right now, we know that the headlines, that data is going to hold up for the rest of the year. The red line here is the active market. The green line is the cohort of newly listed properties this week. So in each week, new properties get listed, and they are priced based on the market conditions. So the sellers and the listing agents know very clearly about how much demand there was at the house down the street. They know how much traffic there is. They know how many buyers are running around in their market. This is what we call the wisdom of the crowd. So the crowds are all of the agents together and all the sellers together. And at a national level, you can see very clearly this early signal. What happens is in the second week of January, prices start climbing. Then June 30th, they start falling. And so it's a strong seasonal pattern. We have it exactly right. In the new listings actually peak at the end of May, so that the full market actually peaks at the end of June. And so you have this early indicator each inflection point. And what we see now, of course, is that we are not falling back at all on the new listings. That's because they were listing, they're going fast, they're listing, they're buying. Transactions are happening at the price very close to listing price, over asking, multiple offers. All of these signals go into why our new listings are going to price strong. So we're at 315 right now in the new listings, and it's been basically flat for several months. And so rather than pulling way down like it normally would at this time of year, I would expect our October, November, December to pull back like we do seasonal. You can imagine that like in 2017, here was a softer pullback than in 2018 when rates were climbing. It was a stronger pullback. So you can imagine that we will watch this number pull back to about 300, 290 by the end of the year. And you can imagine the home price active market to pull back around probably around 325 by the end of the year. But what happens is that'd still be like an 8% year over year price gain for 2020, like an insanely strong market. Um, and then, of course, all the headlines will be reading that in the first quarter. You can see it now, but the headlines are going to tell you in the first quarter. So keep an eye on your Altos data to know where that's going. And then, of course, by the first quarter, we'll be able to look at these data and see, wow, is there a flood of distressed properties coming in? All of a sudden, have interest rates affected buyer demand? And we'll be able to see those very quickly. And so you may, and your buyers and sellers will want to know right away what's happening in that market. So that's why we want to keep our eye on the active data. Okay, I'm going to switch here to sharing some Altos reports. And let's look at some national data here. Let's start with state of California. In California, we have the market action index, again, is our at a glance, how's the market? Well, this number is climbing. That's because inventory is falling and demand is increasing. It is at 60 right now, which is ultra high because it's a state level. Occasionally, you'll see local markets that are at 60 that are just being gobbled up. 30 on this scale is a balanced buyer-seller market. Below 30 are your buyer's opportunities. Inventory's climbing, demand is weak enough that will be associated with prices pulling back. And there are buyers markets in very few places in the country, but I will show you a couple as we go through the data. So median home prices in California up from 648 to almost 800 this summer. Price per square foot climbing, days on market falling. Here's our price decreases. So California, because it has we have chronic shortage of inventory in California, both from Prop 13 that keeps properties from coming on the market, as well as low construction rates. So we generally have a lower price reduction rate than say Texas or Phoenix, for example. So or Las Vegas. And so right now we're at 22%. It's been around 22% all summer long. You might find that as in a California market that cools, you'll see it at 30 to 35%, where a cooling market in, say, Phoenix would go 40 to 45%. So knowing that for your local market is important. But right now it's super low, and of course it's super low because the demand is there. People are buying everything in sight. Price increases. This is a fascinating number. I'm going to show you this one a couple of times as we look through the local markets. Price increases. These are properties that came off the market and came back on at a higher price. Typically, these are investors or flips. They are, sometimes it's like they were pulled and it's a remarketing technique to list it at a higher price. 3% is and it's climbing this year, and that's because it climbs as demand increases, so you get more and more people doing things like flips. Now in California in general, you have it's a harder market to do that because things are priced high and the inventory is tight, super tight already. I'll show you some other areas where that's really climbing. And relisted, this one is super powerful. So when we're in a market of weak demand, or contracts falling through, or people pulling out, now a property gets relisted. It goes into contract, the contract fails, it gets relisted. The listing expires, it comes off, it gets a new agent, it gets relisted. We're at only 1% relisting rate this year, right now in California. That's another signal of demand happening. If you start watching this number climb, then that's a signal. That's another of the leading indicators in the Altos data that's going to tell you that prices are likely going to have to adjust. In 14 years ago, when I started Altos Research, we were looking at the relisted percent for San Jose. And San Jose was hotbed, lots of subprime. And before, as the bubble was growing, uh, it, the houses would go super quickly. And then all of a sudden, days on market started climbing. And a house started looking stale if it was on the market for more than 30, 40 days. They would get pulled off the market. They would wait for a few weeks and then they would get relisted. This number climbed to like 30% for San Jose just before the bubble burst. So the key here, and we see, wow, you have 30% of these homes getting relisted. It's nuts. So keep your eye on the relist percent. Right now it's ultra high. It's in line with all the other data. This is California, and you can see what's happened with pricing in California this year. We have our normal seasonality of the past few years. You have your first lockdown, pandemic lockdown, and then bam, our fall, spring, and summer has just been outrageous. We're looking like we're at our peak for the seasonal peak, and then we'll get our adjustment down to begin the year again. If we look at the price range quartiles, the high end of the market is notably slower than the low end of the market, but these are $3 million properties. You can see that there's still a lot more going into contract than there is getting newly listed. So the demand is there, and the market segments, I always advise my Altos clients and readers to keep your eye on your price range. The high end of the market may be behaving very differently from the low end, so that's why we do the market segments in here. Okay, let's dive in a little deeper. In San Francisco, in a couple of zip codes, you can find buyer's market condition. So 94105 is south of Market, San Francisco. It is right by all the big tech companies that went virtual. It has been a hot market for a bunch of years with a lot of new construction. And you can see that we are in a, prices have adjusted down this summer. But what's fascinating is, at the low end of these markets, they're still moving pretty quickly, 60 days. The high end of these condos, longer. You can see the price dropped. We can look at inventory here and see what's happened at inventory this year. So we're at multi-year highs for inventory, and that's why we're in buyer's market for the first time in years. Now, it's not screaming deal because people are actually still buying these. But you'll see, here's our relisted. Look at relisted, it's 12%. That's because people are like, I'm not getting the price I want. I pull it off. Well, I'm going to relist it, come back, or a contract falls through. So this is notably higher than California as a whole. Something to keep an eye on for what's going to happen for the pricing in condos in this part of San Francisco. What's interesting is we looked at a bunch of other zip codes in San Francisco. There's not that many that are in buyer's territory. They're notably cooler than the rest of the country, but they're actually still inventory. I mean, inventory is chronically tight in San Francisco, so it's not a surprise that it's still really a seller's market with a few exceptions. So 94105, you can see buyer's market in that part of town. In Manhattan, you can see buyer's market as well. Manhattan really, and New York has really its own orbit of real estate prices and cycles. The Wall Street numbers and immigration and foreign money, so a lot of things, a lot of different construction than the rest of the country. So it has its own orbit. But right now, condos in Manhattan are in buyer's market territory. Median price, ticking down a little bit over the last few months. Price per square foot ticking down. So you can see that that there are those. You can see inventory climbing over the summer. These are similar to what we know about being in the buyer's market conditions. You can see inventory climbing from May, and it shrank during our lockdown period by a ton, but now we're climbing back up. So you can, so a lot of, so Manhattan condos, another place where it's sort of buyer's market, but basically everywhere else in the country is sellers. It's red hot. People buying everywhere. Here's Texas. Texas is at a 47 sellers market, so strong sellers market. It is inventory's tight. We can look over here at, here's our relisted percent is only 1%. Price increases. So 7% of the properties have had price increases. Texas is a notably better market for investors, for flips, for the iBuyers, that are buying properties and from a consumer and then turning around and selling them again. So 7% of the homes have had price increases. 30% price decreases. So this is again, this is good for Texas, because Texas generally has significantly higher inventory per capita. In fact, Texas has 64,000 homes, which is low for Texas, but California, with 40 million people, I think it's twice as many people as Texas, has only 36,000 homes for sale. So this is a Texas market different. So here's inventory in Texas. Normally 100,000 homes on the market right now, and Texas has 60,000. You can see where the demand is, right in the middle of the market. The low end, the ultra low end, and the higher end takes longer to sell, but really, these are your high demand parts of the market in all of Texas. But this is just a remarkable drop in inventory. Crazy, crazy demand going on. And we can look at prices too, and you can see what's happened to prices over the year. And so we're at record high prices for Texas. So that's all of Texas. By the way, when you're looking at your Altos reports, a couple of things to keep in mind. I like to put these in my own inbox. I email them to myself, use the Altos system to email them to myself each Monday. So I look at them and I know, I have my house in the mountains and I look at it and I look at the different places. But you can also use the search box, and you can when you hand your Altos report to your clients, tell them to use the search box so that they will look around and you can have access to the whole country. The share button is for your clients to share, email it to their friends. Like, hey, here's my realtor's report. You should check it out. That person then converts as a lead for you. So, when they use the data, they are now your leads in your Altos report. Okay, let's keep looking. This is Georgia. I was talking with the folks at Path and Post Real Estate in Georgia recently. And we were talking about the market in like Gwinnett County. I think I actually have Gwinnett County open. Again, Georgia, here's inventory, way down. Here's prices up with a little plateau this summer. We're getting ready for the fall. Price per square foot is climbing. Here's our price increases, 8%. So the investor and iBuyer opportunity is happening more aggressively in Georgia than it is in Texas. Relisted is only 2%. All of these things are showing how the market is in Georgia. And again, as I show Texas and Georgia, like this is what's happening in the whole country. Let's dive in. I think this is Gwinnett County where Path and Post is. So stronger sellers market than Georgia as a whole. Days on market is decreasing. Here's our price increases, 10% of properties that are coming back on the market with a higher price. Like that's pretty significant. A lot of investor activity, a lot of flips going on. And you can imagine as prices climbing. If you're in this business or you have clients who are in this business, the flip business, what you'll want to keep your eye on are the the median price of the new listed cohort, because you're going to see that in there. You're going to watch, you're going to want to watch the price decreases. Like if price decreases starts climbing and you've got some homes in the middle of your flip period, you're going to want to know to accelerate or know about where you're going to price, be really precise on where you're going to price this house when you list it, because you've got flip competition. And if we're in a case where price decreases are climbing, that means your buyers are backing off. Right now, they're not backing off, but that's what you want to keep your eye on and what you want to have your clients keep their eye on. Let's look at Nevada real quick. Nevada, strong seller's market. The home prices are also plateaued this summer, and price decreases are starting to climb a little bit in Nevada. Price increases at only at 4%, so it's a little less hot for that activity than, for example, um, Texas or Georgia. We have here's pricing in Nevada. Nevada, especially Las Vegas, is super volatile. High beta, like a high beta stock means it moves faster than the market as a whole, like the whole country. So Nevada, Vegas adjust demand back off very quickly, and prices adjust down very quickly and up on the upside very quickly. So you can see started off the year 2020 very strong, had a very strong pullback during the beginning of the pandemic, and has recovered to being at record high levels. You can see, like Texas, the strong demand in Nevada is right in the middle of the market. So we have, the 350 to 500 price range. And, if you think about that, at a 3% interest rate, a $500,000 home is very affordable compared to rent in a place like Vegas. So like that, those are, you can understand why homes are moving at $400,000, because that is a super affordable at this price point, at this mortgage rate. Um, for just a little bit of a cooler market, I picked up Illinois. Illinois is still seller's market, still strong seller's market, still increasing. Here's our price decrease number in Illinois. So Illinois at 39% at the end of last year. We're at 29% right now, and likely uh, to reach 30%, and maybe then before we adjust by the end of the year. But inventory in Illinois is down. Uh, Price increases are much fewer, 1%, relisted at 3%, and our price decreases 30. So you can see that Illinois is a little bit cooler than, for example, the Texas and Georgia markets. Price is lower, but still, like, that's the universal story across the market. When I go into the back end of my Altos system, I'll give you a quick tour. I did some work on Twitter, and we were covered in Bloomberg this week, talking about Montana, and it's really fascinating to see which of my clients are using, which parts of where they were looking from, and where they were looking at. Here's Whitefish. There's some investors. An investor from New York um, bought bought a place in Whitefish, moved from New York, sight unseen. Really fascinating to watch and know which of my contacts are interested in which parts of the country where they're moving. I use this all the time. With your Altos reports, you have all your contacts and you have your campaigns, so you know exactly where people are looking, which ones they're reading, et cetera. You can see the open rates. So these are the how many send, and we have 100. I'm sending in my little account here 187, and 114 of those emails are getting open. Like, it's a super powerful way. Everybody needs to know what's going on right now, and it's really your opportunity to work with them. So I will share there, and I will share here my last little screen again, and we'll wrap it up. let's see, go on to my end slide here. If just, I think you probably get the message. The low supply is totally supporting home values. Demand is off the charts. People are buying everything in the country. Interest rates are really the risk factor for 2021. If rates climb, I would expect inventory to climb, and I would expect um, demand to fall back, and maybe prices to adjust depending on where rates go. But we spend a lot of time at Altos and with our team here with you to help you understand, help you communicate how you can work with your clients. Um, if you're if you're working with clients right now, if you've got listing presentations coming up, if you've got a database of folks who need to understand, buyers that need to understand what's going on, and you're not putting market data in their inbox every week, or sellers that need to be able to keep their eye on the market or understand why they should list with you, if you're not putting market data in their inbox every week, you're likely missing out. We do have a promo code, Sept20, for those buying right now. You put in that coupon code that gives you a discount for 3 months on Altos, gets you up to speed, lets you work with the team. So you should go and do that right now. Very much looking forward to working with you. You can get the data at Altos. You can run a report for your area. You can follow us on our YouTube channel. So we've been doing our weekly videos on our YouTube channel. So check those out to keep in mind. And we'll do this again next month. So look forward to having you working together. Thanks, everyone.